Welcome to the Collective Genius Podcast, the show for real estate investors who are looking to scale.
Welcome back to the Collective Genius Podcast. I am your host, Leon Barnes. Thank you for joining us for another episode and all the great, kind words that have been sent my way, the reviews, the shares, all of those things. Much, much appreciated. This is the podcast for real estate investors, where they come when they're looking to grow and scale their business, whether that business is single family, multifamily, they're a landlord, they're a flipper, they're a wholesaler, hoteler, novations, you name it, anything under the real estate investing umbrella, we serve that community. So thank you again for joining us here today. And speaking of everything under the umbrella, I've got a real estate investor here for you today, Collective Genius CEO member, Mr. Lon Welsh from Denver, Colorado. You're going to love this one today. Welcome in, Lon. How are you?
I'm fantastic. Thanks for having me.
Of course. Love having you on, my friend. We were talking pregame here about, your background is less traditional than what you would see in the Collective Genius. In fact, you came to a Collective Genius meeting many, many years ago when your model was a little bit different. We'll get into your history, but let's start with where you are today, your companies that you run, what your niches are. Tell a little bit about, tell people where you're at and what you do.
Yeah, I started a real estate brokerage called Your Castle Real Estate a little over 20 years ago, and then I grew it to be the largest independent in Colorado. We have about 750 agents. I sold that to a private equity fund in late of 21, but I'm still helping to run it, so I spend a little bit of time on that, which I actually really enjoy. I really like the people there a lot, and it's a good way to understand what's going on in the market.
Agreed.
I launched Ironton Capital in June of 22, a couple months after I sold my last business. And we help people invest passively in real estate. So we're a private equity fund.
Mm-hmm. And specifically, I know it's commercial. Anything else that you're investing on that fund?
Yeah, we've got a couple of income funds for people who want income now, and one of those is in medical receivables. The other is a hard money fund. Actually, very similar to what a lot of other people at CG that I've met are doing with their hard money funds. And then we've got a long-term growth fund that's all in commercial real estate.
Okay, awesome. We'll get into a lot of that, but as you know, you've listened to the pod. You know that this is a journey, what I like to call, conversations with geniuses, specifically for entrepreneurs. And again, you started the retail operation, sold that now into funds and a lot of commercial, bigger projects. So you've had an evolution here that I know that a lot of our listeners are excited to hear about. So let's start with, Lon, you are a very calculated individual. From the day that I met you via Zoom and to the day I met you in person, and even today, you prepare at a very high level, and you're very calculated and driven by data. That's just from being around you, I've gotten. What is it that you wanted to do as a child?
So my dad was a hospital administrator, so I was around a lot of physicians growing up. So I initially thought I was going to be a radiologist, but oddly enough, I thought radiology would be interesting because it was more technology driven and less, my back hurts or I've got diabetes, which is the same thing over and over again each day. My wife is a physician in internal medicine, and a lot of her patients have long-term chronic diseases, and that didn't sound appealing to me. But interestingly, as soon as I learned anything at all about radiology, what I really wanted to do is I want to be the guy that leads the radiology clinic that owns all the big machines and have a bunch of radiologists working for me. And that was my goal, by middle of high school, of what I wanted to do.
How did you, it was very early on, you were business. You were like, I love this medical piece, but I want to do the business side. Where did that come from?
Something that no one probably knows about me, as no one's ever asked, is that one of the main things my dad and I had in common is he would come home from work each day and we would watch the nightly business report on PBS, the public broadcast system, together each day. And so I was sitting next to him, learning about stocks and bonds, probably from age 6 onward. So he started bringing home Business Week and Forbes and Fortune, and I would read those probably starting by age 8 or 9.
Wow.
So by the time I got to high school, I'd already been like immersed in business for like 7 or 8 years. So I guess it's been there for a really long time. It sort of like just naturally sort of fit with me.
Yeah.
And it's funny because I
Do
started.
that, Lon.
It's funny as I started college as a pre-med, so I was going to major in chemistry and get a minor in business because none of the doctors I'd met had very much of a mindset for business. I didn't want to be like them. And I took my first economics class and it was like, wow, this is really fun and I'm really good at it. And then I took my first finance class and it was the oddest experience where it's as if you already like had known a lot about something for your entire life and you didn't know it. Like one day someone handed you a key to a room in your brain, you got to unlock it and like all the stuff's in there. Like, I'm really good at this. This is what I should do. So I switched to a business major and chemistry minor from that point and dropped the idea of going to medicine.
I know that there's a lot of people, especially today, that feel like college, isn't important. I would push back on that because of what you just said, Lon. Like, I feel like people, when they're maybe in high school, understand what they want to be, but don't really know all the things that go into that. You learn that in, it doesn't have to be college. You can learn that in any secondary education,
Mm-hmm.
but you have to you have to go and feel like, to me, you have to go and do the thing in order to know if you're going to love that. And usually what happens in college is you go in with this mindset. Like I said to you before the show that I wanted to be a broadcaster. And I did that for 5.5 years and realized that I like this, but I don't like it enough at this wage.
Right.
If I loved it, I would have just kept doing it for $30,000 a year, right? And hopefully it would have gotten better and made more money. But I would push back on those that say that college isn't important or vocational schools and things. I think they're super important to realize what you love and what you're really naturally good at. Would you agree with that?
I think so. And, I'm lucky that I had the epiphany and I found something. And by luck, something I found was something that pays really well. I think there's other people, they find something like I love drawing or sculpture, and then they realize that they can't make a living doing it. My daughter started as an art major, and then she realized, wow, these people are really good. I'm not that much better than anybody else, and I can't make much of a good living at it. Maybe I'll like do something else. And she switched to accounting of all things, which night and day from art, but she's really good at that.
I will say that I've had these conversations with my wife about our youngest. We know our oldest. He's destined to go to college. You can just see it. He's 13 years old, and he's me. He's a little me. My 8-year-old, though, I can tell that he's more art driven towards more of like my wife's family, more musician and artist. I was like, that's okay. He can go get an art degree with a business minor.
Yeah, yeah, exactly. I mean, maybe he'll end up running a gallery, and that might be the best of all worlds.
To your point earlier is, maybe I'm not the doctor. Maybe I'm the one that's selling the equipment to the hospitals, right?
Yep.
Put the best of both worlds together. So you graduate from college, economics, you fall into this, you're like, this is like the kid that was on the stage for the first time and says, I want to be an actor. You figure this out. Where do you go from there?
Well, I was lucky enough in one of my accounting classes, I had a really fantastic teacher assistant who worked at Deloitte and was coming back to get his master's. But he was telling me that, what you should do, Lon, is get a job as a strategy consultant after you got to, graduate from here, go work for like a Fortune 500 for a couple of years, go to a great MBA program and maybe a strategy consultant. He explained what that would involve. And I said, that's what I'm going to do. So I worked for a big company called Kimberly-Clark for a couple of years out of undergrad. So if you've heard of Kleenex or Kotex or Huggies diapers or Scott paper towels, they make, if you need to absorb something you don't want, they make it. So I worked there and had 3 different jobs with them over a couple of years through their financial manager program. Then I went to Vanderbilt, got an MBA, and then I worked as a strategy consultant for 8 years at Deloitte and then Accenture.
And where was where are you from originally? I know you live in Iowa now, but you're from Iowa originally. Where'd you grow up?
Like halfway between Des Moines and Minneapolis, there's a place where 3 railroads converge called Mason City, and that's the only reason why the city's there is because there's three big rail lines and a bunch of grain elevators.
Yeah. And so from there, where did undergrad?
University of Iowa.
Iowa. Okay. And from there, you got your MBA, you said, at Vanderbilt.
Yep.
So you're working in corporate. At some point, real estate comes into play. Where is that?
Yeah, it's interesting. I got out of grad school, and I'm working on a financial plan for figuring out like when can I retire and what would be involved in that. And the kind of the rule of thumb is that you can save some amount of money and take out 4% per year if it's just invested in traditional stocks and bonds at Vanguard. So if you say, well, I want to make this much money and divide it by 0.04%, you need this gigantic sum of money to be able to have or a reasonably, comfortable retirement. And I was thinking, God, it's going to take a really long time to save that much money after tax. Is there any other way to do this? So I will be the only person on your show that read Rich Dad, Poor Dad and got some inspiration from that. Did some research and found out wow, you can make a lot more money in real estate than you can with stocks and bonds. So I need to learn more about this. That was the initial ignition. And it just really took off from there.
That's interesting that I think everyone,
Everybody read that book.
I think everyone did got some inspiration from it, especially I get this from military a lot. People overseas that they read this book while, they were stationed overseas and realized that when they came back, even if they had a traditional job, they were going to invest in real estate. And it just, it's again, goes back to always learning, right? And taking something, because you had the same epiphany that I did. Unless I became Marv Albert or Bob Costas or, a big name like that, it was going to take me some time to get to a point where I felt like I could actually grow a retirement and have, a decent living. And I had that epiphany and went, hold on, I've got to be able to do something else with the skill set that I feel like I have and continue to sharpen. At some point you read this book and you take action. What was the first piece of action that you took on the real estate side? Were you still in corporate?
Yeah, so I was working at Deloitte as a consultant. So I was traveling, 200 nights a year. I really loved the work, loved the people I worked with. Most of the problems that we worked on were really, really interesting, but the travel got to be a little bit much after 8 years. So the first thing we did is we bought a 4-plex and a 9-plex. So we didn't, even start with anything all that small. And the realtor who I was working with at the time said, this 4-unit was in Golden, Colorado, which is a western suburb of Denver that's really beautiful. And it's right next to this giant school called the Colorado School of Mines, which is a really well-regarded technical school. It was like
Ryan Weimer, who is a podcast guest on CG and a CG Premier member, went to that school.
That's not an easy school to get into, and it's an even harder school to graduate from. So it says a lot about him.
That's school, correct?
It's a very difficult school. So since it was so close, we said, why don't we convert these units into condos? And then there's enough affluent students that, their parents will probably buy them from us instead of, renting for 4 years. So that's what we did. So I did a condo conversion. That worked out reasonably well, but the realtor ended up making as much money as I did. And I thought, I should probably just get a real estate license. And that was really fueled by my frustration in not being able to find anybody who really spoke my language. Because I'd ask realtors, which neighborhoods are most likely to see rental appreciation or just overall appreciation? What's the supply-demand dynamic on a neighborhood-by-neighborhood basis that's driving that? It's like you're just speaking in Portuguese, you didn't even get a response back. So I had to do all this damn work myself. So we figured out, we took Denver, broke it into 450, this is after I got my license. Took Denver, broke it into 450 neighborhoods. We hired a programmer to write an algorithm to take the raw MLS stats, assign each of the properties, sold or active or under contract by neighborhood, and then we built the supply-demand curves by neighborhood and figured out here's what's likely to happen next with pricing. Turns out that's actually pretty accurate. So instead of putting on a blindfold, throwing a dart at a map saying, I'm going to buy a rental there, we actually had some science behind it. So I thought, if I've got this, I can't be the only investor who'd like to have some logic. I'll start a brokerage and help investors do a better job. And it worked.
It's interesting that you bring that up, because I know that there are investors, and this might be the first time that this is brought up. We all love great realtors that are very investor friendly. I said great. And obviously, like anything else, there's the 80-20 rule. I think on the realtor side, it's more like 9-5. But that's true respect to the 5, and no disrespect meant to the 95, but be better. There is, especially when it comes to investor relationships, it is very hard, very, very hard to find the agent that knows what you just mentioned, because most times the track is one track. There's no two lines of audio, right? It's just one track of audio. It's all retail. And they don't think from a perspective of the investment size. And maybe that's good for us long term because less competition, I guess. But what if you are listening to this and you say, man, I cannot find an agent, I would take the advice that you just got from Lon and say, it's going to be very hard for me to find that individual to do that more than likely. So let's just go and do it ourselves because it's not just going to happen through osmosis.
And if you're earlier on in your career, what you're going to find is that your job really is finding deals, and that's your full-time job. And you do a lot of networking to find off-market deals. You go through the MLS in near real time to find deals that way. And if it's one, like everyone's going to have a slightly different set of parameters in the Rubik's Cube that is a good deal for them. So your set of parameters isn't going to match somebody else's. So when you find the really good ones that fit you, of course, you cherry pick those, but you need to have a Rolodex of 20 active investors on speed dial so that when you find one that's a near miss for you, I'm going to call Bob. I can place this afternoon. He'll write an all cash offer. All this thing sold in 3 days. And then you're just in the placement business. And then the commissions you generate from that help you to fund the acquisitions of your long-term buy and holds because everyone runs out of cash pretty quickly. That's a way to solve that.
Yeah, and great advice. So after you do all of this calculation, you start to figure this out. How long until this becomes a full-time gig for you?
So I was in Denver for 4 years before I quit and went into this full-time.
So what year is this full-time?
I left consulting in 2002. So I've been at this for 23 years full-time.
Okay. So 2000
dog years.
You go, no doubt. I've been in 11 years in corporate, 10 years in real estate, 7 years with Collective Genius. And I'm grateful for all the relationships and all the knowledge, but man, it feels like 20, 30 years in a good way, but it does feel like that. 2002, you make this. For those that are listening to this, we've got all levels that listen. For those that are looking to make that jump, what made you make the jump after your 4th year in Denver?
So I was in consulting from 94 to 2002. So for those of you guys who can remember those years, that was when the internet was launching, NASDAQ was on fire, and anything that was technology related was just like, a rocket. So my consulting practice was largely with high-tech companies. So it was just a great big party. You might remember that NASDAQ peaked in 2001. It crashed in 2002. All those internet companies selling dog food for below cost went out of business. All of our clients went away, and 2/3 of us got fired. This is something I needed to do, but I got pushed out, which was happy as I got like a nice check on my way out. But I tell you, for those guys who aren't in that position, it's really hard as an entrepreneur to take the leap, to leave the recurring W-2 job to go do this. But, do as much as you can, part-time, nights and weekends, and you'll eventually have to get to a point where you're at critical mass where you can say, I've got to try this, and hopefully it works out for you.
When you made that jump, were you holding assets? And if so, how many did you have at that point?
We had a few more than that. I was a part owner of a 40 unit. I still had the 9 unit. And I had 2 or 3 other like mid-sized sort of buildings. And then we had done probably 7 or 8 fix and flips by that point, made money on all but one. And I had a very first couple months into my real estate practice. So the timing on it actually all ended up working out pretty well. But at the time, it didn't feel like it.
Well, good for you that you had, this thing that was working on the side that when the .com bubble burst, which if you're young, you probably don't know what that bubble was. But I do remember it because not too far after that was another market crash, which, by the way, at that point, it's now 2004. You're gearing up. There's a big run there. You're now going full time. How did the next 5 years go for you?
Yeah, so from 2002 to like the first part of 2007 was just a mania for real estate. So there were some misguided reforms from Washington that really loosened up lending standards so that we had what was called a stated income, stated asset loan, where you would meet with your loan broker and say, yeah, I make $300,000 a year and I've got this much in the bank. I want to borrow $1 million to buy a house. And they'd say, yep, that's fine. Here you go. Go buy something. So we had unbelievable buyers that just had no business buying a house. And as an investor, the standards were so loose, I couldn't believe it. Like I bought a 5-unit building. We put a manager sign over the 5th unit, so it looked like a 4-unit. The appraiser came out, wrote it up as a 4-unit. I got 100% loan to value loan on it, and I walked away with my commission money from the close. I didn't even bring a nickel to the closing table. It was just insane, the things that you could do. So, of course, all these people were completely unqualified. It all came back to bite us in 2008, 9, and 10. But for a while there, it was really a great practice. So we really took a 2-track approach where I went to every investor club meeting I could possibly think of and gave classes on real estate trends, how to get started in investing. Here's things I've learned from investors. We did a map showing what are the best neighborhoods to buy rental properties in. We did a map on here's the best neighborhoods to buy fix and flips in and why, and just attracted lots and lots of clients. And as a byproduct, we got a lot of residential, traditional owner occupant business out of it too. So that was pretty great.
So crash happens, you built up. And by the way, you know when you know something's too good, you know that there's something on the other side. I bought my first house in 2003, and I remember, maybe 4, I think it was 3, but I remember at the time the agent saying, Leon, you qualify for a much higher level home than what you're wanting to buy, right? And you do know that you have 100% loan. And I was like, yeah, I know all those facts, but that scares me. And I wasn't in real estate at the time. And I just remember going, no, I'm going to buy what I can feel like I can afford. And I really like this. I don't need any more. And you're giving me 100%. Oh, I don't have to come to the table with anything other than some closing costs.
Yep.
If that, like, something's not here. It's not up for me, right? So I knew, even though I wasn't in real estate, unfortunately, I live in Florida now, and this state got hit hard. Nevada got hit hard. Phoenix, and Arizona, lots of Arizona got hit hard. How was it in Colorado?
Well, the judicial laws in Colorado are a lot faster than many other states. So the foreclosure process is very rapid. So we went into the correction faster than anybody else. So there's all sorts of national headlines about Colorado leads the nation in foreclosures for a while. So we just, went into it first and we came out of it first. What was interesting is the overall market declined by about 25%, but there was a huge spread depending on the neighborhood. So if you were in a nice neighborhood that was maybe like 3rd-time trade-up buyers, so back then like an expensive house might have been $800,000. Those neighborhoods almost lost no value at all, and they had almost no foreclosure activity because everybody had a really big down payment, and everyone has 2 jobs, so they're not going to give up their house with a lot of equity. On the other end of the axis, you've got these not economically affluent neighborhoods where you have mostly first-time buyers or renters, and the first-time buyers were just like you described. They put nothing down. So as soon as one of the 2 people in the couple loses their job, they've got no reserves. So they're like, defaulting on their mortgage like 30 days later. So the neighborhoods like that, you'd see a 65 to 70% correction from the peak in the prices. So the overall drop of 25% really tells you nothing. It's like saying, what's the average temperature in America? It's 54 degrees. Well, do I need a coat in Florida? It doesn't tell you anything. So saying that the price dropped by 25% is meaningless. So it was really interesting in that we saw all these neighborhoods have these gigantic 2/3 drop in price. So Brent Geyer, who's the CEO now for my private equity fund, he's a CPA by training. He and I sat down in probably like mid of 2009 and said, I don't know if we're at bottom or not, but if we're not at bottom, we're close enough that it's okay to try. Let's get the financials for all of the HOAs in these neighborhoods that have been beaten up so hard and analyze them, figure out what 10 HOAs are most financially solvent. And we just started buying as many as we could. So I bought 140 of these condos and townhomes in 2008, 9, and 10. He bought, I don't know, a couple dozen. I can't even count how many we sold to clients, but it was just this bonanza. I had this great memory of seeing a deal on the MLS, buy a 4-pack of 8 condos, 4 1-bedrooms, 4 2-bedrooms for $320,000. And I did. And I sold all those things for like $160,000, $180,000 like 6 or 7 years later. It was just unbelievable.
Those that were, set up, Doug Hopkins and I have this conversation. He built, his business, a lot of that in Phoenix in 10, 11, 12, and maybe even before then. So those that were geared for it could. Obviously, you were buying at that time when did, you got to 700 plus agents at your brokerage. When did you shift at some point to go to that model? Were you still buying while building that model? How did that look?
Yeah, I was growing the brokerage all the way throughout. And actually, the first phase of the downturn was absolutely gut-wrenching. I remember a time in January, February of 2008 when the inventory had boomed. We'd have like 12,000 listings. We had like 29,000 listings. It was like almost 2.5x a normal amount of volume. And the showing traffic was zero. Nobody was looking. And the prices are just like falling down an elevator shaft. And I remember looking at this saying, like, I could really be in a lot of trouble here. Fortunately, it worked out. So the way that we spun this is I did two things during the downturn, and this is something I'd want all of your listeners to sort of focus in on, is that, a bad market, you need to apply judo. Judo is just using the opponent's mass against them. So if you've got a bigger, stronger, faster opponent, you just need to find some angle to turn that to your advantage. And there's always a way to do it, so you have to look at it. So there's two things I did. The first is there's a lot of successful owner-occupant focused agents. It wasn't difficult to figure out who those were from looking at the MLS traffic. And I started calling a lot of them up saying, looks like you're having a tough time like everybody else in the market. Investors are really busy right now. Would you like to come to a class where I'll teach you how to work with investors so you can have something else to do while you wait for the normal market to recover? I set a lot of appointments for classes, and it was easy to set recruiting appointments after that. And for the people who don't respond to that, what we did is we took a look at the MLS stats of the people who were owner-occupant focused that were still doing well. It wasn't very many, but there were some. And I did a survey to a group of agents, high producers with big losses in their production, high producers that were still doing well. And I did a qualitative survey of calling all of them up and saying, can I interview you? And I wrote a book on how you can succeed in a down market. I did a bunch of classes based on that. And that also was a great way to set up hiring and recruiting a lot of people. So actually, the downturn was the best thing that ever happened to me from a recruiting standpoint.
There's so much good in that, Lon. I don't want to gloss over it. The biggest takeaway I want to give there is just a couple, actually. Number one, in any market, there's always a problem or a challenge.
Yes.
There's always a solution for those that find the solution, right? You found a solution to allow yourself to continue to grow and attract and scale your business. And I know that, it's 2025 and, it's the time right now where people are not sure, where days on market are starting to go up. Regardless, stop just dwelling and waddling in the challenge and look at the other side of it. What's the potential upside of a downturn? Like, if that is going to be, prepare for it now. We were just mentioning this, that we had an all hands on deck call today for the Collective Genius. And a lot of it is just, all right, guys, we know that there are some challenges in the market. It's not 2020. It's not 2021. So what are we going to do to come out of this where all of us win, the sellers win, everyone wins? You have to have a solution. And that's the first piece of that, is you gave value because you found a solution to the issues, the challenges. Those people were starving, more than likely. It's like, I can afford to go and learn how I can potentially eat again. The other piece of that is it's just it's driving. Like, a lot of people say, I just can't get things to break for me. I can't, they're not, my luck is bad. You didn't wait on luck. You went and made things happen, because you could either, again, just sit there and dwell in it, or you can go out and do something about it. You wrote a book, you said. You then taught people how to make money in a down market. Those are all solutions that really, when everyone else is staying here, you start to make your way up because you're offering solutions to people's challenges. I can't stress that enough, and just didn't want to gloss over it. That's a fantastic point you make there.
There's always some angle out there. I first got my license in 2002, and it was starting out because I'd been laid off. I didn't have any clients. So this is, 2002 in the Jurassic age, where if you had a vacant rental, you'd put a for rent sign out in front of your house. I went around all my rentals that I had, and I drove circles around my rentals. I wrote down all the addresses and phone numbers of the for rent signs, and I called all the landlords up saying, hey, I've got a rental 2 doors down from you. Here's what I'm seeing for my rents. What are you noticing with your trends? I'd love to see your building. Would you call me when you're going to do your next showing to a prospective tenant? Maybe I can meet you right before or right after so you don't have to make a special trip. And I joined the apartment association. I'd like this book of stats from the apartment association. I said, I'll bring some of the stats from the apartment association report for your neighborhood as just an incentive to try to get like a meeting. And you'd be amazed how many meetings I was able to set up that way. And I just stayed in touch with all these guys. And over the next 2 or 3 years, I did lots and lots of deals with them. And that's all I did for prospecting.
Again, instead of, looking at those people as competition, you saw collaboration opportunity. Another great point. All these things are, when people come into Collective Genius, I say, just don't worry about competition. Come in, grab what you need. But while you're grabbing what you need, make sure you build as many relationships as possible and collaborate as often as possible, because you never know when those relationships are going to, not only from a national standpoint, but also from a regional standpoint in your backyard, especially in this particular case, they're going to help you. I try to make as many relationships with local investors as I possibly can in my backyard, because there's always going to be something that they can't move or I can't move, or they need a portfolio. All of a sudden, they fall on hard times and they need to sell a portfolio, and they're coming to you about it. So all good stuff there, Lon. So you're growing now because you are taking action. You're building this retail business 700 plus. And I know when you get to 700 agents, heck, when you get to 7 agents, there are challenges that come with that. I always hear people joke about it's called a brokerage because you go broke, kind of manage it. Obviously, you did not. So give me some of the takeaways of why you were able to consistently grow that and have success with that agency.
Well, I think the economics of the real estate brokerage model are that it really comes in 3 sizes. There's the 1 or 2 person team. There's having a fraternity of like 15 people who all get along well. And then there's like 100 agents and more. And really, anything between like a dozen and 100 is the valley of death. And you've got to get through that as rapidly as you possibly can. And what I mean about that is really what you just alluded to, is that if you've got 50 agents, you'll have overhead costs of having to hire a couple people full time and have a physical office and whatever other expenses go along with it. But you don't have enough commission income coming in from the split side to cover it. So which means that you were probably a high production agent before you decided to start your own brokerage. And, all the money that you're making selling houses during the day, you're using to fund your brokerage. And then you spend all weekend like reviewing files and all the other things that come with running a small business. And it's really a very not entertaining time. So you've got to get through that as fast as you possibly can. So other businesses, like I started a title company with a friend and grew that to a pretty good size. We sold that to Compass in late 21. Title's the same thing, high fixed costs, but once you hit your fixed cost base, it's almost all profit after that. So I think you just have to have a good plan. So when I decided to launch the brokerage, I thought it'd take me 10 years to get to 200 agents. So I was pretty shocked when I got to 200 agents in like 6.5 years. But we really tried hard to get to scale really quickly. And that's probably true for most businesses that have got a fixed cost structure.
You grow it, you get to a point where it's profitable, and then at some point you say, I'm done with this. I want to sell this. How does that start?
Well, I think everyone's got like different levels of pain tolerance and different parts of the business they enjoy more or less. So the title company, my business partner on that was really good at operations. So he handled all that. So all I really had to do was business development, which is probably the only thing I'm really good at. So that didn't take a lot of my hours. And then on the brokerage side, I basically, as soon as I had enough cash flow to afford to hire someone, I'd hire somebody. I didn't want to make any money from it. I didn't want to bleed a whole lot out. And I'm relatively good at hiring. The 5 key people I hired 12 to 15 years ago, 4 of the 5 are still with me, and the 5th one left to start her own company up. And I was really proud of her for doing that. And she's still in business 7 years later. Like, go. It's fantastic to see that.
Love to hear that.
So, getting a really good team is critical. So I got it to probably by 2012, like those 4 guys could run the business without me day to day. And I was just there to provide support when they got stuck with a question. And here it is 13 years later, like they're still running it day to day. So I sold it to a private equity fund, and they kept me on in a CEO role, but I don't spend a whole lot of time there. And really, it's still the four of them that run it day to day. That was my preference. So when I launched the private equity fund, exact same thing. Like as soon as we could afford to hire somebody, we did. And as soon as I could afford to hire a good CEO, I did, because I don't want to be on the field as the quarterback getting beaten up. I don't want to be the coach on the sideline yelling at the quarterback when the play doesn't work. I want to be up in the owner's box having a glass of champagne watching the action.
So you start Ironton Capital. For those that are not familiar with private equity, and just give an overview of what you were trying to accomplish when you first started. It may not be what you're doing today, but what was the goal when you started it? What did you want to do?
So I was an active investor, probably like everybody else on this call, from 98 to current. I think I still own a lot of properties, just less than I used to. But starting kind of about 6 years ago, it started getting harder to find things in Colorado that made sense. And starting 5 years ago, it was like almost impossible. What we saw in Colorado, and a lot of you have seen this in your markets as well, is that the prices of these homes had gone up to the stratosphere. And while the rents were still going up, they're going up at a much slower pace. And so as the gap gets bigger, the cash flow gets smaller. So I wasn't able to get the types of returns that were interesting for, like, I have a target dollar per hour I want to make in anything that I do, and I couldn't make it as an active investor anymore. So I started thinking about, well, could I invest passively and do almost as well from a return standpoint, but if it doesn't take nearly any of my hours, and then I've shifted all the risk from myself to somebody else, I'm an LP now, a limited partner instead of a general partner, that might be a worthwhile set of trade-offs to make. So I spent about 1.5 years researching it, and then started the first fund is just for my family and I, starting in 2019. And by 2022, we had completed 4 funds. There's usually around 10 investments in each fund. And it was clear, like, this is going to work. Like, I'm making about as much or even a little more than I would have in the past in Denver. And I'm not like doing this. All I've got to do is evaluate the projects and then figure out how much capital to allocate to build a well-rounded portfolio to diversify the risk out. So my wife has a friend who runs a physicians investors group. And she was complaining to me in probably March of 22, we can't find anything to buy that cash flows. And I said, well, here's what I did. Do you want to learn about this? She said, that'd be great. She gets 53 physicians on a Zoom call. So I explained to him what I'm doing and said, if we all work together, I could write checks for $500,000 or $1 million at a shot instead of 50 grand. I can negotiate much better deals for us. I'll see deals that I would have never seen otherwise that are much more attractive. That in and of itself will probably pay for my fees. Here's how private equity fees tend to work. If I'm not successful, I really don't get paid anything. Do you want to do it? Pretty much everybody said yes. I raised several $1 million on that Zoom call. I said, this is what I'm doing next.
Love that.
It's like my whole career and everything I'd done in my entire life led to, like, I've got the whole skill set needed to do this.
You had the connection out of the gates as well. I mean, that's, you took full advantage of the opportunity that came your way. So you had to, now you've got more responsibility. You are actually finding operators to trust to put this money with, correct?
Yes.
So walk me through that process. There's a lot of operators that are listening to this that, are looking for investors, especially in bigger projects. How did you start out of the gates? I'm sure it's different maybe today, but how did you start vetting operators for this fund?
Well, the good news is I had a 3-year head start just with my family and I's money. And I wanted to eat my own dog food to make sure it was all right than anybody else. And we made a lot of mistakes and really refined the process a lot. So, I'd done some syndications before that. So we initially just started with a network of projects that we knew of people in Colorado, but it's not easy to find projects that make sense here. So the angle that helped me beyond, other than networking, which was a lot of it, there's a commercial designation you can get called a CCIM, a Certified Commercial Investment Manager or something like that. So I had that when I was selling apartment buildings forever ago. So if you get on the CCIM website, you can sort it out by asset class specialization or a bunch of other different filters. So what I did is I had one of my teammates said, why don't you call every CCIM in Alabama who specializes in multifamily, explain what it is we do, and ask them, hey, do you have a deal that really makes a lot of sense? But since the lending guidelines have changed a lot, Remember, this is like middle of 22. So the rates were starting to go up. The banks were a lot less excited about lending and underwriting got a lot tighter. So deals that would have gotten done 6 months ago aren't getting done now. So you call the broker, say, do you have a deal that won't close because you need another 5% LTV to get it done? You're going to find a lot of stuff. So we just made a bazillion calls to a lot of brokers and kissed every frog in the pond. And eventually we found deals that made sense. I wish I had like an easy answer for you, but we just boiled the bloody ocean to find them.
Did the work again, did the research, looked at the resources available to you, did the research and did the work on the other side. Let's talk about the other side. Speaking of, when you're raising capital, and I know we're going to talk a little bit more about that. What's your approach? Are you doing that? Is someone on your team doing that? Is it full time? What's the approach that you take with Ironton Capital?
So we've got 12 employees. So there's 3 of us on investment committee that just look at deals all day and fly out to go visit people and double check on things. And then there's 4 people who are in investor relations on the fundraising side. And then we've got some people in accounting and other tasks like that. So initially, most of the initial people who invested with us were either people who I knew personally or they're one network step removed. And I can talk about use cases of types of investors that we attracted and how you talk to them. That may actually be useful. But what I wanted to do was like what I did with your castle. As soon as I was able to, I hired a full-time recruiter for agents. And then we just spent a lot of time together with me training him. And I think this is a common small business owner mistake. So maybe I should talk about this for a second.
Sure.
Every hour you invest in training a new employee, you're going to get like 100x return. And I often hear that people don't spend a lot of time training their employees and they're disappointed that they don't get the outcome that they wanted. Like, well, are you surprised by that? But for sales in particular, like, no one's going to be you and be as good as you are at sales, but you should be able to get someone who's almost as good, and that'll be more than good enough. And that was the main point. So I don't know if I'm getting to the core of your question or if you want me to try to attack it a different way.
No, you had mentioned the potential case studies that you could go a little bit deeper on. I would love to hear that.
So we find there's 2 segments of investors for us. So the first segment, well, let me rewind a bit. I've written 13 books, almost all of them on real estate, most of them about investing in real estate. So I've been doing classes on real estate investing for 20 years. I've got this gigantic database of people that we've sold rental properties to, but I've also got like a database that's probably 20 times larger than that of all the people who came to my class and said, God, Lon, that sounds really interesting. I think I could make a lot more money in real estate than I could with Vanguard. I don't have the time to do it, but thank you for telling me about it. Well, we stayed in touch with all of them too. So the first segment for us was all the people who had been to a class. We had a trust-based relationship. We've been talking to them for years. They have an interest in real estate, but they don't want to be an active investor. Perfect. I solved the problem for you. That group is really fantastic to work with. And we can talk about that in more depth if you want. The other group is all the active investors I've worked with over the decades. Colorado in particular has had 12 different laws passed in 2024 and 2023 that were all beneficial to the tenant and all hostile to the landlord. There've been a few more this year. So it's really taken a lot of the joy out of owning rental property in Colorado. So it's nice that a lot of the people who I helped bought properties in 2010 and 11, and their properties have tripled in value. And the legislature's made it very difficult to do business here. So, I tell you what, why don't I do an analysis for you? If you keep this rental property and you tell me the assumptions you want to use, I can show you the wealth accumulation your family is going to enjoy over the next decade if you just stay the course. Or if you sell it and pay the capital gains, put it in the stock market or our income fund, here's what it looks like. Or if you put it in our income fund, we've got a lot of depreciation we can give you to offset your capital gains. We can really manage your tax bill. Here's the wealth accumulation. And then your family will have all the facts they need to make a well-informed decision about what to do next. Would you like to do that? It's hard to say no to that. So we've got a lot of tired landlords who want to be passive through that method.
Both great sectors there, and especially great advice for those that, if you're that mid-tier and looking to take that jump to the next level. Maybe you've been in business 3 to 5 years, and I read an interesting quote this morning. I was like, man, this fits on almost every journey of an entrepreneur. It's like the difference between a black belt and a white belt is just persistence and time, right? Obviously, you got to do the work, but it's just time.
Don't give up.
Don't give up. Exactly.
Just keep going.
And especially if you're someone that understands how to underwrite good deals. I mean, it's a lot easier when you have a deal. It's easier to find money for those deals. So, is there a I'm guessing it's multiple, but is there a specific asset class that you look at that as your fund that you want to invest in?
Yeah, a typical fund will usually be about 2/3 in multifamily, and the rest will be industrial, self-storage, or hospitality. And we've got a couple specific segments within those that we really like a lot. That's the asset class. From a strategy standpoint, there's really 3 ways to make money. You can do a buy and hold of a really beautiful asset and pay retail price for it. We don't do any of that. If that's of interest, there's real estate investment trusts that are fantastic. About half what we do is new construction, and the other half is heavy value add of an existing asset that's been neglected. From a geography standpoint, we're pretty heavy in the southeast and southwest. We do have some things in, the north, but not a lot. And then we try to really have a lot of diversity across the sponsors because every sponsor's got their own strengths and blind spots. So you don't want to have all your eggs in one basket.
Has there been you mentioned the interest rate changes in March, April of 22. Has there been an specific type of asset that you've found some wins with because of interest rate changes? Is multifamily, commercial? Is there one that sticks out between that April 22 to today?
I think that there's really good opportunities in all the asset classes. It just really depends on what your expertise is and if they line up with the geography that you know really well, or if you're willing to invest the time to get to know the geography to be able to kind of figure out which segments within the geography make the most sense. You don't want to say like Atlanta. Atlanta's meaningless. You got to know like this segment of Atlanta, what's going on. It's very, very sub-regional. But we focus probably the most on multifamily. Historically, multi has the lowest returns of all the different commercial segments. It also has the lowest volatility and the least probability of losing money. And that's kind of our goal in the long-term fund is I want to get good returns, but the most important thing for me is principal preservation. And multi is a good way to do that.
We only have a certain amount of time for the pod, so you don't have to list all of these, but is there a win that you can think of in your career that stands out because you learned, you've made money and learned a lesson? And then the opposite of that, has there been one that stood out that was a loss, but it was such a great lesson that it's made you millions on the loss? So if you could think of one win and one loss where you gained knowledge and you said, like, this really helped me get to this next level or make this deal because of that deal.
I've got a story that'll probably give a couple of good lessons to your listeners that you can use. So this is 2016. So I had been renovating mid-size apartment buildings for quite a while. And I came across an office building that was in foreclosure, and I had never bought an office building before. And this building is in a really nice location in central Denver. They're asking $49 a foot when it should be trading at $149 a foot. And it's just cosmetic stuff. It's nothing complicated. Like, this is like a fix and flip, but just for 40,000 square feet, nothing overly complicated. So I go to all the banks that I know. So I had good relations with 3 of them and said, I want to do this. And they all said, we love you. We think you've got a great track record, but you don't know anything about office, so we're not going to give you the loan. I'm like, really? This is like, you hear about like Walt Disney going to like 50 banks or something to get him a loan to build Disney World. And like, I thought, well, that's Disney. That would never happen to me. So I went to the bank that had foreclosed on the property and said, look, I want to buy this. I need a loan. Will you do it? And they said, we'll do it, but we want to have a couple other guarantors on it. Like, okay, I don't have a balance sheet for you. I'll get some other people to help me out. So what I did is I recruited some people who could help me do the project. So the general contractors I'd worked with on several projects successfully in the past became business partners on this. They didn't take any GC fees, but they got a lot of really nice bonuses for being on budget and on time. And then Brent Geyer, who had done a lot of work with that condo HOA analysis, you remember at the last fall of the market, and he's my CEO now, so we've worked together for a long time. He was going to help me with some of the coordination and leasing up. Then I had one other person, CPA. And I went to all the guys and said, look, I actually want to keep this building. So what we're going to do is pre-negotiate a price today where when we get to this level of net operating income or this level of occupancy, I've got a 12-month option to be able to buy it out at this price. And if we back solve, if we stay on budget, you guys will get approximately a 100% ROI in about 24 months. Would that work for you? And they all said, yeah, that sounds like that'd be fine. So pre-negotiating the option was the key thing. We more or less were on time and on budget. I did buy the guys out. And when I did that refinance, I got almost all of my cash out as well. And then I had this 40,000 square foot building, not for free, but for like maybe 200 grand out of pocket. And then I kept it for another couple of years, and it doubled in value after that. So that worked out really well.
There are a lot of people that are going to hear that story, Lon, and say, hold on, this is like black belt type of information. I think the biggest thing I want to pull out of you here is for the person that doesn't know how to do all those things. Where'd you pick that up? That wasn't something that when you left consulting and left corporate, that wasn't something you knew then, was it?
No, this is my first syndication. I'd never done one before.
But where does that come? Like, you didn't, I mean, obviously you had never done that before, but you had to have talked to someone or had a mentor or read something. You didn't just go into it blind, or maybe you did.
So one of the great things about owning a large brokerage is that you've got a front row seat for a couple thousand transactions a year. Usually like 800 or 1,000 of those would be investor deals. And you can talk to those agents saying, tell me about the deals you're working on. And they'll tell you all about them and the assumptions. And then you can ask them 2 years later, so how did that deal turn out? Like, it was fabulous. Let me tell you why. Like, it blew up. Let me tell you why. So I got to learn a lot just from watching other people, which was really helpful, including a lot of people who did syndication. So I was aware of the concept, but I didn't know much about them. So I asked a couple of the guys who did syndications, could you introduce me to your attorney that drew up all the docs? And Evan Husley was a guy who did that at Foster Graham McAllister. He spent like an hour with me, and I paid for it. It was no problem at all. It was like the best hour probably I've ever spent of an attorney's time ever. He walked through all the mechanics, and I said, here's the problem I'm having. I think this is one way of structuring it. I had maybe like 70% of the Lego blocks, but he gave me the other 30, and then he restacked them in an entirely different way. And I said, that's the way we need to do it. Then he just wrote it up. So I guess what I would do is try to find someone in your market. I mean, you should always be networking and trying to meet as many investors as you possibly can. This is entirely a network function business. The bigger the network, the more people who like you and trust you, the better off you're going to do. Not only for finding deals, placing deals, but just for things like this. And then they can, introduce you to like an attorney who can like solve a huge problem for you and create an amazing opportunity. This would work just as well on a 4,000 square foot opportunity as it would for a 40,000. So don't think it's got to be a huge deal. It could be a small deal.
This is why we preach community so much, because there's so many opportunities that come your way that you may not know how to underwrite those deals. You may not know enough about it, but when you have the opportunity to be around, you had obviously a bunch of agents and people that did syndication. I took the same approach. If you're starting out, maybe you're a wholesaler, been a wholesaler for 5-10 years, market's changed a little bit and you need to start flipping and you don't really know. Like, I talked to every single contractor. Coming from corporate, I had no real estate background, went to flipping, and I can't tell you how many lessons I learned from a 90-year-old structural engineer. He couldn't believe the questions that I was asking him as a young person relative to his age. He couldn't believe it. Like, I just would sit in the house. I'd do the walkthrough with him because in Kansas, we have basements and a lot of structural issues, shifting, very sandy soil. And so therefore you would have a lot of structural, but those were the houses that we would buy because those were the ones with the opportunity with structural issues. And the engineer would come out and say, which one do you think would have more issues? A house that was built in 1925 with structural issues, or the house that was built in 2005 with structural issues, right? Makes sense, but you don't know that until you learn from someone that had been doing it for 70 plus years. And anytime you have those opportunities, I know contractors get a bad rep, but there's so much you can learn by just being curious and asking the right questions, which leads me to my next question for you. You've got several, but what do you personally think is your biggest superpower?
Probably, this is not going to be useful to your group, unfortunately. I mean, I did work as a strategy consultant for 8 years, and I am really good at economics and finance. So I think that I'm good at asking questions and then doing the research to figure out what is an opportunity, how big is the opportunity, and then I'm good at doing the research just to ask 1,000 questions. I tell people that really I'm just a very well-paid parrot. I ask a lot of questions, and I just remember what they tell me, and I just package what I hear from a lot of people and then speak it back, and people think I'm a genius. Like, I'm a parrot, and I'm not really a genius. asking the right questions is probably the superpower. That'd be one. I think the second is I'm really good at hiring people and reasonably good at training. If you can have an idea of there's a market need for this, here's how to communicate it to a customer, here's how to build a process to deliver that, and then get the right people organized in the correct way to deliver that, you've got it. Then it's just a patience game. You're going to win. It's just a question of how many beatings you're going to take on the journey to get there, but you've got it lined up. I'm just lucky I've got those two things. I could be good at something else that wasn't monetizable. I'm just grateful that I can do this.
I would add one. I think you take what you read and you don't just sit on your hands. You take what you learn and you don't just sit on your hands. You actually take action with it. I think that's in itself is a superpower. When I'm hearing you talk through these superpowers, you have said several times, training. And I don't care if you're listening to this and you have a $1 million business or a $5 million business or a $10 million business in real estate investing. At some point, you're going to hit what Lon mentioned earlier is that valley of death. You're going to hit a point where the team that got you here isn't going to get you to the next level. I see it a lot between $5 and $10 million to get over, especially at 10. 10's kind of that number where I see people right before that, they're in that valley of death where they just have to level up and train and level up the training that they're doing to get past that lid, that metaphorical lid that they have there. If most people on the pod so far have not said that's a superpower, but I would argue that's most of their superpowers, understanding that the who, not how, and then making sure the who is trained at the highest level and is taking ownership in the business. Like they may not be owners, but because you've invested so much in them, they've invested now as their business. And I think that's a true core superpower for those that are looking to continue. If it's not your superpower, make it your superpower because it can change your life. It can change the frustrations that you have. And clearly you understand the power of that.
So I'll tell you a story here. When your castle grew to somewhere 70 agents plus or minus, like it exploded. Like all of the bubble gum and baling wire fell off the bolus of snot all at the same time. It was just gross. And what we realized is that early on, you're really motivated to get to scale so that you're not bleeding. So if you've got an extra 3 hours in a week, you're going to make those. I would make those 3 hours. I'm on the phone trying to set more appointments because life is a function of appointments set and appointments kept. Nothing else really matters until you get to scale. But that's like 3 hours that you didn't spend like building out a real process and training someone how to run it. So you can bubble gum and baling wire something to a certain extent, but eventually it will blow up on you, as you just talked about. So ideally, what would happen is you would bubble gum this thing until you get to break even and then hit the pause button for a second and actually build out the processes, hire and train, and then hit the gas again. I didn't do that as I didn't know. I just kept hitting the gas.
Right.
So that was a mess, but we recovered from it. But, you will have this unless you take the pause and build the stuff out. So try to do it in a planned way as opposed to an unorganized way like I did.
The analogy that Jason Medley has used since I've known him now for 10 years, is even the fastest Indy cars, the Formula One cars, have to pit stop at some point because the tires need changed, the gas needs filled. In order to continue to go at the same level of speed or faster, you're going to have to pit.
Yep.
Such great advice, Lon. I know a lot of people are hearing this and somewhere on their wall, they have this mantra of all gas, no brakes. You're going to have to brake and pit stop because at some point, the wheels are going to fall off, as you said, and you're going to get to a point where you're just stuck. You're like, man, I can't get past 5 million. Well, there's a reason for, or 3 million. Usually where I see that is usually that $2 million to $3 million mark for most single family operators or those that are value add on maybe smaller self-storage or smaller apartments is what got you to here. It's at some point it's going to redline and you're going to have to build out process because you can't just do it with the team of 5 that you've always done it with. It's so much good here, Lon. I'd be remiss if we didn't get to more of, the training, the books, and all the things that you've done. What are you working on right now that may be of service to those that are listening to this? Obviously, you got a bunch of books that you've written. Are you still doing, classes? What are you doing right now that you're excited about that's teaching?
So I wrote a book recently on how to invest passively in real estate. So if you guys would like a free copy of that, you can go to Ironton Capital, Ironton Capital, just like it sounds. And let me just check this really quick. I think it's /genius gift. So irontoncapital.com/genius gift. And on the Ironton side, if you want to set an appointment with me or somebody on our IR team, you're welcome to do that. If you are a developer with an interesting project, text me 303-619-0633. Tell me a little bit about your project in the text. We're looking for some things in the mid-20s with conservative assumptions. And if you've got something like that, we'll talk to you about that. If you are trying to figure out your first syndication or something like that, text me. I probably don't know who the best syndication guy is in Connecticut, but I'll try to put you in touch with an attorney who's probably one network step away from the guy that you need. These things would take me 3 minutes to do. I'm happy to do it. Just shoot me a text. Don't feel bashful about it.
Love that. And if you need help with that as well, I happen to know a few thousand investors myself that might be able to help you out on that side. Ironton Capital /genius gift is a free book that you're offering up. You gave your cell phone. We'll make sure all of that gets in the show notes. Anything else you want to leave the listeners with?
Something that might be beneficial to you is we do a class just about every Tuesday night at 6 Mountain Time. So if you are on the website, you'll see a list of training on there. So once a month, I do a national real estate trends where I talk about what's going on in the macro environment and what it means for real estate. That probably would be actionable for almost everybody on this call. That's free, obviously, like all of our classes are. And then the other calls that we do, we're doing fundraising. So if you are thinking about doing a syndication, it would probably be useful for you to join and listen to us and see what we do. I don't think we have all the right answers. We've got a few, and maybe we can give you a couple ideas.
So much good there, Lon. I really appreciate you taking the time out. Obviously, your time is valuable. You got another book to write or got another class to host. I will say this, you are the epitome, just hearing you talk more, you're the epitome of what, our culture is built on, which is go giving. And obviously you give all this value, you're going to receive things tenfold, if not beyond. I love the model. I love how you've set it up where you continue to give, and things are just, you're not waiting on luck, you're making things happen. And I truly appreciate your time talking to us here on the Collective Genius podcast.
So I'm delighted to do it. Thanks for having me.
Absolutely. We'll make sure everything gets on the notes. And obviously Lon gave out you're the first to give out a cell phone. So again, thank you, Lon, for your time today. Appreciate it.
You bet. Thanks for having me. I appreciate it.
Of course. So if you would like to be in the room with members like Lon, the best way to do that is to go to our website, thecollectivegenius.com, fill out an application. If you're a good fit, we have a tier for you. If you're a full-time investor, would love to have a conversation with you about this community and how it might be able to help you. All the things that Lon talked about before, getting in the room with people that know how to do things that maybe you don't at this point, but you will because you'll have the people. You're in the right room at the right time. And we thank you for listening to the Collective Genius podcast. If you want to see all the past episodes, you can obviously see those on YouTube, the collective cgpodcast.com. Subscribe, all those things, guys. We really appreciate all the support that you've given us right out of the gates. And we'll be back here next week and dropping another great podcast with Conversation with the Genius. We will see you then.
Are you ready to scale your real estate business? Visit thecollectivegenius.com, where real estate investors come to scale. Subscribe to the Collective Genius podcast and hit the bell icon to be notified when our next episode releases. And thanks for listening.